Personal finance. It is that area of your life which can change the way you experience your being. When you make good financial decisions, it helps you to grow your wealth exponentially and it gives you the headspace to do the things that you love. On the contrary, making bad financial decisions have the power to really mess up your mind and it can leave you hanging with financial burdens. Hey everyone, I hope you all are doing well. In today's video, I'm going to walk you through 7 common financial mistakes that if made can ruthlessly erode your wealth. If you are new to the channel and are eager to dive deeper into the world of personal finance, then do join our community by smashing that subscribe button. So the first financial mistake that people make is ignoring health insurance pitfalls. Under this point, I want to cover 2 things. One is the room rent limit and the second is the copay percentage. Starting off with room rent limit, it is basically the maximum amount of money that your insurer will pay towards the rent of a hospital room on a per day basis. Now, when a person gets hospitalized, it is important to see that the hospital room's rent does not exceed this limit. Now, you may wonder why, because after all, comfort for a patient is the most important thing, isn't it? Well, this comfort brings along a huge financial distress with itself. The thing is, when the hospital room's rent exceeds the rent limit set in your insurance policy, then you will not only have to pay for the differential rent amount, but you will also have to pay for all the other medical expenses in proportion to the exceeded rent limit. Let me simplify it for you with the help of an example. Let's say that the room rent limit in your insurance policy is rupees 5,000 and the rent that your hospital charged is rupees 10,000. Then in that case, you have exceeded the rent limit by 50%. The effect of this would be that if your total medical expenses, including rent, comes out to 3 lakh rupees, then you will have to pay 50% of it. That is 1,50,000 rupees from your own pocket. So yeah, comfort comes with a cost. Likewise, the second pitfall under health insurance is the existence of a copay clause in the insurance policy. Copay or co-payment is the portion of the total medical expenses that the insured, that is you and me, agree to pay when a claim is filed. Generally, copay can range from 10 to 30%. A 30% copay would mean that if the total medical expenses are 1 lakh rupees, then 30,000 rupees will have to be paid out from the insured's pocket. When taking a health insurance policy, one should ideally ensure that this copay clause is not there. But yes, such policy would have higher premiums. Only if you can't afford the premium of such policy, one should at least try to ensure that the copay does not exceed 10%. The second financial mistake is improper management of liabilities. Usually, if you have a stable income, then low interest debt on appreciating assets is not an issue. There are 2 reasons for it. First is that the interest is charged on a reducing balance, meaning that as the debt becomes older, the absolute interest burden keeps on decreasing. And secondly, since the loan is on an appreciating asset, there is always the option to sell the asset and get rid of the debt, while also encashing your part of the equity. Now, some of you may ponder, why is paying interest fine? Shouldn't one try to pay more than the EMI and get rid of the debt? Well, see, it totally depends on your belief system and how you feel with the debt on your head. People who are always stressed about loan repayment should get rid of the debt by paying more than the installments. But someone who is driven by logic and mathematics would choose to let the loan installments be the same and instead invest any additional money that he has in a low risk financial security such as a AAA rated debt fund where the returns are more than the interest charged on the debt. This helps you to not only build a liquid corpus for yourself, but at the same time, unlike loans, here the interest will be received by you on an increasing balance year on year. Now, where the problem really lies is low interest debt on depreciating assets and all kinds of high interest debt, especially those that are unsecured. For those of you who don't know, unsecured debt is where there is no collateral involved. So personal loan, education loan, marriage loan are few examples for this. Ideally, one should stay away from these types of debt. And if one has already taken such debt, then paying it off should be one's topmost priority. It is because when adverse financial situations hit us, then it is these types of debt that have the potential to make us fall in the debt trap. Lastly, one should also avoid overutilization of credit card because it can become a bad financial habit, and a credit utilization of more than 30% of your card limit can also hurt your credit score. Moving on, the third financial mistake is delaying goal-based investing. See, investing is not a rat race to accumulate a certain amount of coppers in your life. Some people confuse financial planning with building an astounding amount of wealth and retiring with a huge load of money. In that pursuit, they also substitute all other aspects of life with aimless investing. At the end of the day, money is a tool which helps you to afford products and services. The goal of financial planning is not to be happy at 60, but to be happy till 60 and beyond. Goal-based investing is basically a wealth management approach that focuses on helping you achieve specific life goals within a certain time frame. It brings purpose to your investments and helps you to choose the right financial instruments to make those goals happen. I've already made a video on goal-based investing, so you can watch it to gain further insights into it. The fourth financial mistake is over-concentration of wealth in one asset class. When new investors come in the stock market and they have a beginner's luck, they witness a good appreciation in their portfolio. But sometimes this beginner's luck can prove to be bad. Why? It's because these new investors start believing that they have learned the art of investing and they get greedier due to initial success. What happens then is that they invest a large chunk of their wealth entirely into equities. While they wait for extraordinary returns in their portfolio, a sudden market crash happens and they lose a significant portion of their investments. The solution to this downside risk is implementing diversification in one's portfolio. Ideally, one should have their money spread into different asset classes such as fixed income securities, real estate, equities, liquid cash, and even commodities such as gold. All of these would serve different purposes. For example, fixed income securities can be used for goals that fall within 3 years. Real estate can be used to create a constant cash flow that is passive income, and equities can be used for long-term goals as the risk becomes lower over longer tenure and the upside potential increases. Striking a balance is key to managing risk and building a sustainable wealth. The fifth financial mistake is not investing in financial education. See, everyone knows that there are two options to gain financial education. One is to subscribe to my channel and the other is to make financial mistakes and understanding that you should have subscribed to my channel earlier itself. Jokes apart, financial education is one of the best things that you can focus on to improve your life. It opens the possibilities of buying you time and making your money work for you. Not having financial education can lead you to fall in traps such as using insurance for wealth building, using equities for an emergency fund, and investing in low-rated debt funds without considering that there are high chances of default. Now, I understand that a lot of people might not have the interest or time to invest in financial education. If that is the case, then all you should do is get in touch with a qualified financial advisor who offers fee-based advisory. If a financial advisor is not charging you any fee, then you are probably being sold commission-based financial products where the returns are actually lower and you end up paying a lot more in commissions when compared to the advisory fee of a reputed financial advisor. The sixth financial mistake is making impulse purchases when you can't afford it. Today, we all spend a significant amount of our time on social media. We constantly watch content that sells us stuff. Hyper-targeted ads are literally everywhere. Well, it's good for the companies that are selling different products and services, but for us, it becomes a window of constant impulse purchases. Not being conscious during buying decisions can lead you to instill bad financial habits and you'll end up buying things which really don't add up much value in your life. This behavior of impulse purchases on online marketplaces and quick commerce platforms is becoming more and more common, and the fast payment options available on the checkout is adding to this issue. I'm not telling you to not buy stuff that you like, but with 25,000 rupees in your bank account, buying a 2 lakh rupees gaming PC, that too on credit, does not make sense. The solution to this issue is to create a comprehensive budget, set spending limits, and if the product or the service falls within that limit, then wait for at least 24 hours to find out whether the product that you wanted to buy wasn't just a fleeting desire. Last but not the least, the seventh financial mistake is having no contingency plan in case your main source of income goes south. What will happen in case you lose your job? How will you manage the transition period where you hover around finding a new job? Not having a contingency plan for this scenario can bring a lot of financial and mental distress. The solution that most financial advisors recommend is building an emergency fund. The size of this fund should be at least 6 times one's monthly expenses, and one should make it a point to refresh this fund as one's expenses rise. Now, there are also certain new age insurance products such as job loss insurance which help you to safeguard your income for a few months in case of a job loss. I personally feel that whatever be your age, it is good to have an emergency fund, and it is equally good to have a job loss insurance. But it is even better if you could keep yourself updated with the latest industry trends and acquire relevant skills that can be monetized. In tough financial situations, having different skill sets can help you to meet your ends in some way or the other. So there it is. These were the 7 financial mistakes that you must avoid from early on in your career. Do share in the comments any financial mistake that you have personally made so our community can learn from it. I hope this video gave you valuable insights and you learned something new today. Thank you so much for watching. Like the video, hit that subscribe button and stay tuned for my next video.